Chris, I noticed your wife in the background. Shout out to Chris's wife. I've stolen Chris.
Hi, actually.
Hi.
Why not?
Hello.
Yeah.
Hi.
Hello. I know I stole Chris.
I'm supposed to say palantir to the moon.
Yeah, no, Chris.
Go away. Go away. Get out of here. Go away.
I know I stole Chris for the past 25 weeks from you.
Yeah, thank you for sharing your husband.
That's okay. You can have him.
Yeah.
No, because no. You have to sit in the other room and act like he knows what he's talking about, and you have to support him. Like, yeah, honey, what you said on the podcast was great. It's like, no, it wasn't. Like,
I actually watch. I used to not like understand anything that you guys.
You still
about.
don't understand.
But
Get out of here with your stupid palantir to the moon nonsense.
Over the past 25 weeks.
Snowflake to the moon.
Wait, hold on. I have one more question for her. Why did you sell when Chris called you like a mafia boss and he's like, sell it all? Why did you listen to him?
I was actually
she listens to Daddy. That's what it is. Daddy knows what he's doing.
My dad's not here.
Okay, whatever. Get out of here. Get out of here. Get out. Bye.
No, I honestly don't know anything about my finance literacy all came from him because I knew nothing before.
That's right.
So I just trust him.
Him and those nice eyebrows. Yep.
Nice.
Well, I bought more this week, so when it is 725, I couldn't resist.
Oh, I bought them. Chris is crazy right now for not buying, but I'm pretty sure he's going to buy very soon. But
we'll see. We'll see.
Yes. Well, again, shout out to his wife, friend of the channel. I'm sure the chat is going crazy right now. They love him. They love her being here. But yeah, definitely stole Chris for the past 25 weeks, so I appreciate you letting us have Chris. Now, Jeremy Grantham put out an article this week saying we are in the midst of a super bubble. So let me take a second to explain this, and then I want to get your guys' thoughts. A super bubble is basically economy crashes, and then it recovers, and then it crashes again, and then it really crashes. So in 1929, we saw this. The market went from 500 down to like 430, or down to 300, then went up to 430, then went down to 96. In 2001, we saw this. We were like 5,000 on the NASDAQ, went down to like 3,000, went back up to 4,000, then we went down to like 2,500. Now S&P was at 478. We went down to 360, went up about, 36% back to 430. Now we're getting back to 390, and the last leg of the super bubble might hit us down much more below 360. And the reason Jeremy Grantham gave, for those who don't know, he's a perma bear, but he's gotten a couple of macroeconomic events correct throughout the past 30, 40 years, is declining corporate profits. So, Dom, what you mentioned about Snapchat laying off more employees and tech companies laying off workers, that seems to say that if we're going to have declining corporate profits because of the macroeconomic conditions, once the market factors that in, there's going to be the third leg down of this super bubble, which means we get a real collapse.
Yeah, I mean, it's really been super volatile right now. So, to Matt's point earlier, I mean, if you're not a long-term investor and you're a trader, you're playing a dangerous game, and you better be on point with your technical analysis because the market's moving erratically every day. And you could, other than Pelosi, you couldn't have predicted how that NVIDIA play was going to come out. The same thing could be if China decides to invade Taiwan one day or overnight. You're not going to be able to recover from the market moving that fast, right? So my guy Chris, man, this is the benefit of DCA. It's just consistency. It's consistency. It's knowing.
But Dom, the super bubble though, like
right. But why would you try to time the super bubble? You could miss that third leg. You could gain that third leg, and the statistics say that when you hold your stocks throughout the years, each year it's those 10 days that the stock market moves the most. That if you're not in the market, then you miss out. I would rather be fully invested and just take my lumps, and each paycheck just keep dollar cost averaging on my companies that I know have a strong balance sheet, no debt, free cash flow, and tailwinds and founder led. I'm going to roll my dice and diversify and make sure that one of those winners cancels out all my losers.
And I want to add to that because I saw an interesting article today specifically highlighting since Jerome Powell has taken office, if you invested $1,000 or just any sum of money, even through these two recessions, one being the pandemic and the second being what we're experiencing right now, you'd still be up 46%. So that's an annualized, 10% a year, which is pretty impressive considering the fact that the market has retraced as much as it has in the first half of 2022. So I think that just goes to show you that even though there's these peaks and troughs, and it goes back to what you were talking about, Dom, you have to realize what game you're playing in, right? And I talk about this a lot on my channel, so I'm not trying to, take over Amit's channel because it's obviously his culture and what he's doing. But I think about 5 things, right? And I think a lot of people, they might see, Chris is doing one thing versus Matt doing another. And some people might side with Chris, some people might side with me. And it's all dependent on 5 things. What's your objective, right? What's your time horizon? How long are you looking? Do you need this money today? Do you need this money in 20 years? Thirdly, what's your risk tolerance? I've invested in things knowing wholeheartedly that they could go to 0 and it wouldn't hurt me because I have a 4% portfolio allocation. And that's happened. I'm like, you know what? This is 40 grand. If it disappears, shit, I lost 40 grand, but my opportunity was $400,000. And that's what I evaluated it at is something that could go up 8, 9, 10x. And I was like, you know what? I have 40 grand. If I lose it, I lose it. And at the end of the day, it was only, a certain percentage of the portfolio. Fourth, which I think is also important, how much time do you have to dedicate? Sorry, Chris, I know you were going to say something, but I have 2 small points to add left, and hopefully this is pretty enlightening for some folks.
Take your time, Matt. Chris has taken up enough time on the podcast.
I see those eyebrows, and I just want him getting wiggling them again.
No, yeah, because when he gets a little hint of I have something to say, he thinks he's a college professor and he can go on. Like, no, you can speak.
Chris is very articulate. I like it when he speaks. I need to take lessons.
We gotta get some other people too. I agree.
So the fourth thing: how consistently are you contributing? Because let's just be honest. If this is your only $1,000 and you say, unfortunately, are handicapped or something like that, you need to invest completely differently than somebody like myself who has been fortunate with their education. It can add consistently, time and time again, month after month. You can take on less risk and get to where you want to be in, say, 20, 30 years versus somebody that doesn't have the capital capability to be able to add $1,000 every month like somebody like myself. And then fifth and lastly, which I think is the biggest point, and I think a lot of people on Twitter get stuck with this, and they just assume based off of what people are doing that it's the way to go. But how much time do you actually have to dedicate daily to the market? And I think that if you recognize that, and I've been there where I've tried, when I first started in 2013 investing in the market, I was like, I'm a day trade penny stocks, man. I'm going to do it. I'm going to go to the moon, and I'm just going to print and, screw this 9-to-5 job. I'm going to be out by by 25 years old and, hit rocks. And it came to the point where shit, I had a meeting to go to. And in between that 60-minute meeting, I come back and the stock's down 20%. So do you actually have the opportunistic time to dedicate 3-4 hours a day to be able to trade? Or are you just lying to yourself? And that, if you answer those things honestly with yourself, not what you want to do, but honestly with what is reality, and it can change over time as you mature and you understand and you ebb and flow with the market, you will find a way of investing or trading that works way better for you. And I think that you need to take all those things into account to truly get yourself set up. So sorry, I don't know what got me off on that tangent.
I'll pass it to Chris here in a second. Just that it's personal. It's called personal finance. Everybody has different. I have 2 kids. Chris is fairly newly married. Amit's making a company. Like everybody, it has their own agenda, priority, debt. So for anyone to say like, oh, you shouldn't invest in this and that, like shrug that off. Like know yourself, know thyself, know what your goals are, and make sure that you're making and you're doing the homework too, and you're not just trusting people on YouTube or Twitter or articles on what to invest in. So that's just my 2 cents on it. Chris?
Yeah, I was just gonna say, a lot of the YouTube finance community, that there's like this new cottage industry of expose this, or this person's a grifter and all this other stuff that's starting to kind of make its way around. And it feels like there's more people right now calling out expose and grift and all this other stuff. And honestly, some of it is warranted, right? Because there are definitely people out there that are giving terrible financial advice, not looking at a lot of fundamental things. But there's also a lot of great people that are giving good advice, but it's a down market. So automatically everyone looks super guilty and super wrong. Like I'm sure that anyone that's been watching us for the last 25 weeks, they're probably like, these guys are fucking numbskulls, like telling me this palantir shit is amazing. And all of a sudden they're selling and fucking buying Snowflake. sorry, I really need to control my cursing. I don't want to get you demonetized on it. I'm sorry, man. But essentially, in a down market, yeah, there's going to be a lot of people that have like this confirmation thing. Like I told you, these guys didn't know what they were doing. Dude, everyone is down right now. Whether you bought bonds, which were safe, you're down. Whether you bought stocks right now, you're down. Like this is unprecedented in the history of investing. There hasn't been a time where both bonds and stocks have been down at the same time. So I would say be diversified in the people you watch as well. So it's not just, okay, let me just tune into Jeremy Financial Education and follow everything he does, or follow Stephen Graham, or follow me, Kevin, follow Amit Kukreja, and just listen to them. Go out, listen. And if they're making compelling arguments that you should probably confirm and research yourself a little bit, by all means, do it. And for me, I agree with you guys. Like everyone's investing style should be very personal to what their goals are and also where they are in life. Like I have something I called like the sword and shield strategy. So basically what I do is my defensive positions are my index positions, and my my attacking positions, like sword positions, are ones that I know that are super high growth, that are super risky. And there are times where you need to shift into nothing but indexes and then shift another time into growth. Like right now, I think we're I don't want to say we've bottomed, but we've gotten close to a bottom. I do think that there may be another 10% that we could further go down, even 15%. But I think a lot of the stuff has pretty much corrected. So now do I like wait until another 10 comes around, or no, I'm going to start shifting my money into more growthy things that are higher risk, but I do know that the risk reward is much higher also, so that's the thing that we should be doing. Like last year when we were at all-time highs, I was starting to shift my positions more into indexes, because I know that, hey, listen, in the index side, I'm going to risk a lot less than I am going to. I mean, I still took a shellacking. Don't get me wrong. Everyone took a beating last year. If you're telling me, hey, you made money in the last year, dude, you are one of the few people that made money. Like everyone took a beating. So I do think that we're at a point where things are starting to turn around, and maybe a time to start looking at the market closely for those companies that, really pique your interest. The other thing, one last thing before I give it back to you guys, do not ever forget about growth. You always make more money in companies over time that are growing like crazy than companies that are paying you dividends. If you look at Buffett, one of the things that Buffett says, like, why doesn't Berkshire authorize a dividend? Why don't they just, say that? One of the reasons why is because, dude, if you have the way that someone explained it to me, and they said very, very like, there was a great explanation, because I used to be a very like, oh, I'm just going to invest in companies that have good dividends and everything else. I missed out on so many gains because I was looking for companies that pay dividends. Dude, if you have to bribe your investors to stay and keep buying your company, that's not a good sign. You typically want to be in companies that are willing to risk capital into their own business, because that business is going to exponentially grow. Like imagine right now you had bought in the year 2005 GE, because you're like, oh yeah, they have a nice juicy 4% dividend. Go look at where your GE stock is right now. A lot of these 100% dividend stocks that like a lot of people love, like, oh my God, this is a dividend like company that I love. Dude, over time, unless they reinvested everything into that company, they haven't nearly grown or outpaced a lot of great growth names. And I think growth has taken such a big beating that you're seeing some really good deals on the market right now. So like I said, I do think there's about another 10% that's going to go, but I don't want to try to risk the absolute bottom coming. So it's
like Palantir. It was at 725. At that point, I was like, I got to buy a whole bunch, because the price to sales, the valuation, the news, like, yeah, am I not happy with some of the execution that they have and how they handle their earnings call? Sure. But the technology is sound, more than sound. And that is harder to create than getting good salespeople to go to market. I believe they will fix that issue eventually. May they fix it in the time that I would prefer? Probably not. But I don't worry about Palantir going bankrupt. I don't worry about them not being a public. They have no debt, 3.2, I think, with all their credit and everything else, $1 billion. and they have a lot of government spending that's going to be coming their way eventually.
Yeah.